Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, October 28th, and this is the weekly market update. The disclaimer, anything that you hear or see on this video or podcast is not to be taken as investment advice. I am not a financial advisor. I cannot give you personal financial advice. I am just a guy on the internet. Please do your own due diligence. It's your money. It's your responsibility. Okay, let's get into it. So a tweet from Jesse Felder, somebody that you should be in your Twitter or X curation of talented people to follow. Here's a quote from Jim Grant, who writes the Grant's Interest Rate Observer. He's been a longtime journalist and commentator on economic policy, the Fed, things like that. And this quote is made kind of a, made me think and had an impact into, the view that I have of interest rates and the current situation in the economy. And it says, I quote, "I suspect that this most sudden and even violent lurch higher in interest rates is going to test financial structures that came into being during the period of very low nominal interest rates," unquote. And so that's kind of my thought too, right? You have an economy, i.e. the US economy, or many economies in the world, the European economy, that for a period of 10 years plus basically got used to almost free money, very low interest rates. You remember at the peak of the bond bubble where you had billions and billions of dollars of government debt that was traded at negative interest rates. That means you were having to pay the government to hold your money in some cases. We in the US had like 10 years of 0% Fed funds rate or near zero. And so what this did is this, when money is free, it enables bad behavior. And so what do I mean by that? When you're doing a project or a business or something like that, or you're going to invest in real estate or whatever, this is done using debt. And when the cost of debt is very low, it enables a lot of malinvestment. It enables a lot of marginal projects that probably wouldn't have got done at a more normal, historically normal interest rate. And in order for us to make progress going forward, that stuff has to be liquidated now. And we're starting to see that, as we've pointed out in the bankruptcy filings and other things. Now, I know that the GDP number came out at 4.9%. I'm not going to get into that. That doesn't impress me. The underlying economy isn't doing well. And I just don't agree, with if you have the price of everything going up and you just measure it with gross domestic product, well, I think you might be using the wrong measuring stick. But anyways, what I think, with raising rates basically a year and a half ago, starting the rate raising cycle and getting them up to 5% or a little bit over 5% on the Fed funds rate, that translates into the economy, right? And we still haven't seen the full effect of all of the previous hikes in the economy. That's still working its way into the economy. That's why I titled this slide, Respect the Lag. And I think as that happens, as debt needs to be rolled for the government, for real estate, for other businesses, we're going to start seeing more and more folks struggling to make this work. And I think that we're going to understand, as Buffett said, who is swimming naked. So I just wanted to point that out. Every day that goes by, every week that goes by, every month that goes by, with rates being held here, that is causing more and more of the constriction, like a boa constrictor on the economy, right? Because as those previous rate hikes slowly but surely make their way through the economy. Again, I use the analogy of a volcano, that's going to erupt. As you get closer to the point of the actual destructive eruption, there are signs before. It just doesn't wake up one day and erupt. Very rarely does that happen. You have increased seismic activity, earthquake activity, minor eruptions, and all of a sudden you have the big blast. So that's what geologists and volcanologists, they monitor these things, and they can have a better idea when the big one's going to come. So I suspect we haven't seen the big one yet. I will note this, though, that I think that we did see news this week that the European Central Bank went on pause after, I think, a year of raising rates. We basically now have, I think, the Bank of England, Swiss National Bank, the U.S. Fed, now the ECB. They all have paused, right? And you know that I've been tracking worldwide interest rates, and the trend is to see, which I have seen now for the last several months, is a trend among central banks around the world to begin a new rate cutting cycle. We're having more central banks cutting rates than raising rates. And so with the exception of maybe a couple other people, I don't think anybody else is really paying attention to this. Now, will it have an immediate effect on everything? No. And are a lot of these central banks in smaller countries? Yes. But as I've said, like when I mentioned Brazil, for example, or some of the South American economies, Chile, Brazil, Colombia, Mexico, these people were on the forefront of raising rates as inflation took off, and they have been now on the forefront of cutting rates. So that's the trend we're seeing. And I suspect that, eventually, I don't know when we're going to cut rates here in the U.S., obviously when something breaks, and we're still waiting for that to occur, which will, the Fed's not going to do anything until they are begged to do it. And what do I mean by that? Well, you're going to have a hard time getting inflation down to 2% in this country, just because you're seeing things like, for example, these labor actions recently is a perfect example. You've got these huge pay raises at UPS and the airlines with the pilots, now at the UAW. I mean, you're talking like 40, 25, 40, 55% wage increases. That isn't across the economy, obviously, but labor is having more and more ability to extract wage concessions from companies. And so what I think will happen is they're just going to hold rates here till something breaks. The markets will be down significantly, and then we won't be at 2%, which is the goal. Maybe we're at 3.5, and then everybody will be saying, we don't care, give us free money. And then the Fed will have the air cover to do what it normally does, which is print money. So that's kind of when does that happen? No idea. Couldn't tell you. No one knows that. Wanted to point this out. This is the S&P 12-month forward price to earnings ratio. This is the nominal U.S. 10-year bond yield, and this is a scatter chart. And it shows you as bond yields go up, the PE ratio tends to go down, right? And what I think is interesting here is the Magnificent Seven. These are the top 7 stocks in the that are driving the market: Apple, Amazon, Alphabet, Meta, Nvidia, that kind of stuff, Tesla. And so this is where the rest of the market is currently. This is the implied fair value with the US 10-year at 4.75. And this is a historical scatter plot. So this is a big outlier. And so the question you have to ask yourself if you're playing around in these stocks is, will the businesses, do those businesses and their performance currently justify this kind of multiple in an environment where rates are currently? And I would suggest to you that based on history, no. But again, I don't think that you're going to see that really crack hard until unemployment starts going up. Why do I say that? Because I think because of the passive investment trend that we've had over the last 20 years or so, basically people are contributing constantly to 401ks, into these funds that are passively run. And so if you put $100 into your, passively run 2040 fund or whatever, a certain amount of the money is just going into the highest capitalization stocks, which happen to be a lot of these Magnificent Seven. So the money just goes in regardless, based on market cap, not on the prospects of the business. Okay, because it's passively run with the view that, on a long enough timeline, things will average out, and your average return historically is, 8 or 9%, and you'll be fine if you just keep putting money in dollar cost averaging for 30 or 40 years. The problem with that is that there are periods where there's outperformance in the market, and there's periods when there's underperformance. And what tends to happen is that even people that have retirement funds or are told this or schooled up on this don't stick it out. When they see their balances going down, they can't take the pain, and they typically do is sell at the bottom against the advice of their financial advisor or of the plan that they signed up for, which is to be a long-term investor and just be passive. That's just human nature. So we will see if this outlier can continue, if those businesses can, in an environment where the economy is getting weaker, where they're overvalued historically, massively overvalued, if they can maintain this levitation. I suspect they won't, but we shall see. Wanted to point this out, current, Bitcoin price around $34,000. I did mention maybe a year ago that I had, not even maybe it wasn't a year ago, 9 months ago, maybe a little bit longer, I can't remember. But I had dabbled a little bit in some Bitcoin miners. I think that, Bitcoin is, in my view, primarily driven by liquidity. When you have more liquidity coming into the markets, when you have a liquidity upcycle, this is the kind of asset that does well in that environment. And so when I couple that with this, the gold price over 2,000 now, are these instruments sniffing out what we're talking about, which is a new liquidity cycle? Or is this just a manifestation of the current geopolitical situations around the world and the instability? Is this just a reaction to that? I don't know. I do know that I think over this decade, both of these assets are going to make new highs that are going to be staggering. Do I think am I ready to pull the trigger? I've been asked, I talked about it in a couple of videos, and I talked about it in some of the free emails that I've sent out. You have the free email list if you're interested. We have the paid newsletter, but we also have a weekly email that goes out where I talk about things like what I'm thinking about doing or what some big trends are. I don't typically get into specific companies, but that is available. You can go down to the show notes and sign up for that free email. But I have talked about it in the past, and I think I actually wrote about the fact that recently, maybe a couple weeks ago, in the free email, about the primary driver historically for gold prices is real interest rates. And if they are trending negative or in negative territory, that's typically good for gold. And I explained why that is. I'm not going to get into that now. But I do think that a new worldwide liquidity cycle, we have already crossed over the apex of peak liquidity contraction, and we are going to move into a new liquidity cycle. And I think that when you see central banks like the EU, the US, what have you, that have been tightening for almost 2 years now, in some cases, switch to a loosening, then you're really going to see these type of assets fly, in my opinion. I didn't have time to do it this week, but if you look at gold priced in various other currencies around the world, it is making new highs in a lot of other currencies. And so, again, am I prepared to go all in? No. People keep asking me what juniors to buy. Yes, I'm going to. I have a junior watch list I have put together. Primarily companies that are currently have drills turning and have the potential for news flow. Am I prepared to discuss that right now? No, because here's the problem with these kind of stocks. They're very highly speculative. And if you get in at the wrong time, you can buy a junior gold stock and they can go down 30 or 40 or 50% in the next month or two. That does happen. And then, you're forced with a decision. Do you buy more? Do you hold it? And this is how people get themselves in trouble. So I want the conditions to be particularly as good as they can be from a historical perspective to give me the best chance at success. And until I see, we have begun the rate cutting cycle around the world. We are going to reliquify. They are going to print money again. That's what they do, these central banks. And this will have a wind in the sail effect for these type of speculations. The thing that you need to be aware of, like in junior mining, for example, is we're coming up to the end of the year. I'm going to be hesitant to be adding things until really close to the end of the year. Why? Because a lot of these mining stocks are down quite a bit, irregardless of the prospects of the company. There, I could talk about many stories that are very, very positive, where drills are turning and all kinds of good assays are coming back and resources are being increased for particular projects. Projects continue to get more valuable, and the stock price goes down. And what you run into at the end of the year, which is what I'm waiting for, is what they call tax loss selling season. So typically what happens is once we get into December, we will see people that have losses in their portfolio. They will look to sell their losing stocks to capture the capital losses to offset the capital gains they have in their portfolio. This happens every year. And in these companies, junior mining in particular, which have very low liquidity in their stocks, this can force the prices down even more and create even more bargains. So I would be looking for my stock picks for junior gold. I might even throw a couple of these Bitcoin miners in there that I've put money into. I'll be looking for that closer to the end of the year. As I might even make a special issue in the newsletter. I'm not sure yet, but I'm very excited about the prospects for a lot of this. I think over the next couple of years, a new gold bull market, a market that I think will exceed a lot of people's expectations. Even currently right now, if you look at the Tavi Costa has put together a chart that shows the current gold price and the gold stocks that have severely underperformed this gold price, which has been positive. And just to get back to where we were, maybe even in previous points where the gold price has performed, we would have to see something in the order of multi-100% returns to get back to what has been typical historically. So I think there's an opportunity there. I just don't think it's the right time. Again, we don't have to do anything except sit here and wait for these fat pitches. There's no reason to go out and buy junior miners right now when a lot of people that are sitting on losses are going to be liquidating those stocks into the end of the year and possibly driving them down even further, 20, 30% more. So I'm going to be looking forward to that. Now, again, we could have, an expanded Mideast war next week where everything just blows up and all kinds of money pours into gold and gold goes to 3,000 and I look like a stoop, but I'm not sure that's, what is going to happen. The probability of that happening is not zero, but I don't know how high it is either. And I don't trade. Okay. I'm looking to get into something that's going to be beaten down. And I think it is going to then go from sailing into the wind to having the wind in its sails, which is going to be a new global liquidity cycle. And just talking about that, I follow these guys on Twitter, Cross Border Capital, and they do a lot on global liquidity. And I didn't put the other chart up. They had another chart up about how China has really done a lot of massive stimulus. And you can see just from some of the shipping and some of the other things that are going on in China that, they're stimulating their economy massively. But you see that your global liquidity index, long-term 5 to 6 year cycles, and you see that we are now, turning up. So this is consistent with I think what I've been saying, we're at the beginning of this, okay? And so it's time to get ready. It's time to get into the starting blocks because the race is going to happen. And so I think that we're already positioning a lot of other resource stocks. I think that energy, I still remain bullish on energy, but I think that seeing this, everything's teeing up and the winds are shifting. So keep that in mind. We are, I think, on the cusp, if we haven't started, to start a new global liquidity cycle, upcycle. Start in the smaller markets and eventually make its way to the developed markets where they will be, again, once these, I mean, Europe's in a tremendous recession right now and self-inflicted, a lot of it happens to be, but regardless, they're in a recession. And I think, you know, we are heading for one, and we will see the same playbook play out as we've seen in the past. Print money, QE, cut rates, that same cycle. So for all of those who thought that global oil demand was going to go away, here's an article from a report from the Economist Intelligence Unit showing that that's not going to happen. So from the article, a new report from the Economist Intelligence Unit shows global energy consumption rising by 1.8% in 2024, hitting a new record high. Despite high prices and supply disruptions, the report shows crude oil and natural gas demand climbing in 2024. Global oil demand is set to rise by 2.4 million barrels per day to a new record high this year and by another 2.2 million barrels a day next year amid an improving Chinese economy, OPEC said in its latest monthly report earlier in October, leaving its demand forecast for both 2023 and 2024 unchanged despite fears of slowing economies and demand destruction. World oil demand is set to reach a record average of 102 million barrels per day in 2023, driven by a 2.3 million barrel demand increase in non-OECD region, OPEC noted. And so I've said this all along. This is one of my main ideas of why I'm bullish on energy longer term. Global energy demand is going to continue climbing because of the developing markets around the world and their desire to grow their economies and become more wealthy. They require more and more energy inputs. This ridiculous notion you can in the West that you're just going to unilaterally, you know, stop this is not going to happen. And I've said this before, and I'll continue to say it. If you don't want to burn the molecules in the West, they'll just burn them in the global South and East. They will get burned. So you can choose to self-immolate your economies, which in some countries in Europe they've decided to do, and we're trying to do here in the U.S. Unsuccessfully so far, it seems, but they are pushing. But those barrels, those tons of coal, they'll just go to the global South and East. And so, you know, I thought it was amusing this week. Again, Shell came out with another, talking about the oil company, Shell came out with another announcement about further cuts to their non-oil, shall we say, renewable efforts. The CEO has been adamant that his focus is going to go back to the core competency of Shell, which is the extraction and production of hydrocarbons. And I think that you know, this idea that oil demand is going to peak at some point and go down. Well, I think there's going to be supply issues going forward because of underinvestment, and I think that's where a lot of the opportunity is. But demand, I don't think, is going to peak for many, many, many years. Wanted to point this out. I mentioned it a couple weeks ago. Libya parliament threatens oil embargo. This is a little bit of a clickbait headline. It was on oilprice.com. There's like two parliaments there in Libya and the government, and the one that doesn't really control the oil said this. But what I'm trying to tell you is that there's a lot of people in the Arab world, people that are practitioners of the religion of Islam, that are very upset with what's going on in Gaza. And there is a potential, I just wanted to point this out, there is a potential risk that if things get too far out of hand and too intolerable, because you have a very big difference between the leaders of these Arab countries and what they call the Arab street. Arab Street is very, very sympathetic to the Palestinians and what's happening, very anti-Israel in many cases. The leaders of these countries understand that it's a fine line that they have to walk. They will not really get too involved with it, and they're still having to appease their population. So again, not going to try to put a probability to it, just telling you that that risk is out there. It's not zero, and we'll see what happens. I still have view that later on this year we could see the OPEC cuts be extended again into 2024, but we'll see what happens. On this article, a couple snippets here. It says Libya's eastern-based House of Representatives has called for the immediate exit of ambassadors supporting Israel amid airstrikes on the Gaza Strip and demanded that Libyan oil exports to those same countries be halted, according to Turkish and Libyan media reports. Quote, "We demand the government halt oil and gas exports to countries supporting Israel in case the Israeli massacres are not stopped," unquote. Parliamentary spokesman Abdullah Belahak said in a statement on Wednesday. Again, this particular part of the government doesn't have the power to do it, I don't think. But again, it's a view that I think is not just held in Libya. And I think if things continue escalating or more and more pictures come out, people are going to there's a potential for this to calls for something like this to grow even larger. We shall see. Wanted to talk about another article about offshore oil drilling. Title of the slide, Operators Offering 15-Year Rig Deals as Availability Dries Up. From the article, as offshore drilling rig utilization increases and availability continues to tighten, Westwood has recorded a marked lengthening of new contract award durations, as well as for new tender opportunities. Westwood believes that further lengthening in average rig deals will be seen over the coming year. Interestingly, there are already 10-year tenders out in the market for a pair of drill ships required for campaigns beginning in early 2025, which is unsurprising considering marketed utilization of 6th to 8th generation assets is already at 97%. So what's happening here? Not enough rigs to support all the drilling campaigns that everybody wants to do. So people are looking to lock rigs up for multi-year campaigns. As a matter of fact, there still are cold stacked rigs, and there are discussions about bringing some of those back. It's a tremendous effort, right? It could cost close to, I've heard, $50 to $100 million, closer to the $100 million, to bring a cold stacked rig back online and get it ready to operate again. So I think this is the environment that we thought we would end up in. We're there. And so I think we just monitor the situation. Unless oil crashes to 50 or below and stays there, I don't see anything changing in the offshore market. As a matter of fact, I just saw yesterday that Exxon made another big discovery off Guyana. So this trend here in this circle of between, of the Atlantic Basin continues to, show more and more prospects. We are particularly interested in what happens in offshore Namibia because we have a lottery ticket in the Actionable Intelligence Alert portfolio that has a stake in the Total project, Venus project, offshore Namibia. So I think I've said that before. I said that I think that I'm not a geologist, I'm a generalist, but just based on my reading and what's happening, I think that the possibility of what's happening in Namibia is Guyana is a pretty good corollary to what the possibilities could be. So we'll have to see as Total and others shall continue to do their work, but we could be looking at another situation. Again, though, I think a lot of the activity is moving offshore. Schlumberger said the same thing in their recent quarterly report. Last snippet here. Westwood predicts that as contract duration and utilization continue to increase, coupled with decreasing availability and day rates heading further north, lead time will lengthen as operators become more concerned with securing the right assets for their upcoming campaigns. So people will be paying up, I think, to sign longer duration contracts, and that just takes, more rigs out of circulation. Again, I think this just stays bullish until you see a new build cycle, and we're nowhere near that. So I'm staying long offshore services. Here's another article about the offshore drilling comeback. This is like in a mainstream media article. I can't remember who, but they finally figured it out, right? It says the big three oil field service providers, Schlumberger, Baker Hughes, and Halliburton, have said for months the hottest new spots to drill are shifting from the West Texas plains to the waters off South America and elsewhere. Now this week, Chevron made a $53 billion bet on the deep sea oil deposits off Guyana by agreeing to buy Hess. Meanwhile, Noble Corp, the biggest offshore drilling contractor by market value, is gearing up for explorers to put as many as 10 deepwater rigs back to work next year. Compare that with the Federal Reserve Bank of Dallas' latest survey of shale executives, who said the number of U.S. onshore rigs is apt to remain flat for the next 6 months. So this is what we've been talking about. Nothing new here. I just thought it was interesting that the mainstream media is now finally awoken. I did forget to mention this. We saw the recent, I think a week or two ago, the acquisition of Pioneer Natural Resources by Exxon in the Permian, and now Chevron making a $53 billion acquisition of Hess, which is pretty big offshore Guyana. They got quite a big offshore component to. I think most of their oil is offshore, and they are big players in Guyana. So I think what we're starting to see now is possibly a new mergers and acquisition cycle in the oil patch. That would be good because activity begets more activity. These folks are limited, I think, in some cases for growing production and reserves via the drill bit because of ESG and things like that. And so I think that the possibility of seeing a mergers and acquisition, play out over the next year or so could be good for the market and wake people up, generalist investors, to what's really happening in the energy sector. And it's like, okay, there's a lot of activity, or who here's next, speculation on who would get acquired, who would be the acquirers, that type of thing. And so, yeah, this is looking good. We just had a portfolio player that's a big service provider that does a lot of subsea work, basically underwater pipelines and all kinds of apparatus that drillers need, came out with really good earnings and really good forward guidance. And so again, I think we have that nailed. We're just riding the wave now. Are the products the same they were 2 years ago? No. Do we go higher? Probably. But again, that's why you have to get in early. Here's another guy I follow, Ed Finley Richardson. I don't think it's the guy's right name, but he's a shipping guy on Twitter. He also has a Substack. I would follow him. I would put him in my curation pool of people to follow if you're interested in shipping or in offshore service vessels or rigs. He does pretty good, and he actually is a pretty good writer and will get you to chuckle quite a bit. Anyways, his tweet from last week says mid-size PSV Aurora, as a service vessel, Aurora Horizon, was fixed today for $30,000 a day. That equals, this is a Norwegian Corona, but basically 30,000 pounds per day is $36,000 a day. What I wanted to point out here is this last year at this time, these things were only getting, these boats were only getting 11,000 pounds a day, or in October, but in November it was down to $6,000 a day. So you are anywhere from 3 to 5 times higher in day rates for service vessels in the North Sea. And this isn't just specific to the North Sea. This is across all of the basins. We're seeing higher rates, higher utilization. The same story that we just talked about in rigs is present in the service vessels also. So again, expect higher cash flows, lower debt, and higher payouts to shareholders and higher stock prices over time. And again, no one's trying to kill the golden goose yet by going out and building a bunch of new vessels. So until that happens, I'm just holding what I have in these stocks. So uranium, new 52-week high, $74 a pound on the bid, 74.50. It's a new 15-year high for U.S. nuclear. Okay, so we haven't seen that price since early 2008. I remain bullish on uranium. I am getting less bullish on a lot of the juniors. Why? They're overvalued, and I'm seeing more and more private placements now in dilution. It's really time, I think, to focus on what you really own and what the prospects are. If you are speculating on a greater fool or some kind of super spike and then everything just spikes along with it, including the stocks, that could happen, that might happen. I personally don't want to sit around and watch some of these companies just dilute themselves and tell their story. Very few projects will actually come to fruition. So it may be prudent in many cases to prune the portfolio and basically move from some of the junior exploration stocks that you have big gains in directly into, maybe the Sprott Trust or even URNM, where you're into the more higher capitalization stocks, companies that actually have production and a lot of the physical uranium. So that's what I probably am going to be doing, because I just don't want to sit here and watch these companies dilute themselves. We're seeing a lot of private placements. There's a lot of activity, and you have to really know what you own. How much cash in the bank does the company that you own, the junior that you are having visions of sugar plums, how much money do they have in the bank? Because if they don't produce any metal and have no prospects, they have to go back and issue more shares, and that dilutes your ownership. And so how much of that's going to take place? Again, if you're betting on a super spike to 100 or 200 or 300 or whatever, which is not outside the realm of possibility, then you have to hit your timing down right too. Does that happen in the next 6 months, next week, 3 years from now? If you don't know that, then you will be looking at dilution. So something to keep in mind. Again, I think I'm going to be looking to offload some of these companies, and like I said, shift into the more stable metal and for the final push higher. It doesn't mean I won't own some of the juniors, but I think this time now to really, in my opinion, really understand what you own, understand who the managements are, understand if the prospect that they have or the project they have is actually legit and has a path to being developed. If it doesn't, then you really probably need to really think about part of that. Speaking of uranium, this was a blog post from Adam Rosenzweig. He's managing partner at Goring and Rosenzweig. Here's the quote: "I think that it's entirely plausible to see uranium at $300 in a spike," unquote. Of course, that sounds clickbaity, but it kind of lays out in the blog post why that could be possible. Again, the probability is not zero. There is some probability, percentage-wise, that this could happen. I don't know what percentage to assign to it of the possibility, but it is possible. I think uranium prices head higher, and I do think that we may be in a situation. I think that there may be musical chairs. I've said before, where there simply isn't enough uranium for everyone, and you could see a spike on that. But again, I'm just a generalist. I don't know every mine in the world, every prospective mine, tracking it against every reactor. I mean, I simply do not have the time. I don't do this full time. So I do know that the supply demand imbalance is in our favor, but there's a lot of opinions out there of what that means. So take that into consideration before you get this 300, you anchor $300 uranium in your brain. From the article, from a demand perspective, utilities are captive buyers that need to get their hands on the fuel, said Adam Rosenzweig. Meanwhile, supply is expected to remain tight for the foreseeable future. He goes on to say, I think over the long term, on a sustainable basis, both supply and demand can probably sustain $120 a pound, and that would be enough to bring on supply over time. However, prices could spike well above that level for a brief period. I think that it's entirely plausible to see uranium at $300 a pound in a spike, Adam told the Investing News Network. Now, that won't be sustainable, but it almost seems likely. You never want to say certain that you're going to overshoot that $120 a pound. I do think we'll make new highs in the uranium price on a spike. I don't know if it'll be 300, 400, 1,000, who knows? I think that will happen at some point once the market realizes that there isn't enough uranium. And I think that a lot of money is going to start coming into this market. Goes without saying. But what's the timing for that? Is this going to play out over 3 to 5 years? Is it going to play out in the next 6 months? I don't think anybody really knows that. Again, if we're heading into a recession, typically what happens is, we have these elevated stock prices now. The bear market, I think, in stocks is developing, I think, finally. We don't need additional rate increases. I think if we are anticipating a recession, you will see pullback in the general equity market, could be 30 or 40%. I think in a environment where stock prices are down 30 or 40% in the overall general market, call it the S&P 500, what have you, I think even uranium stocks and resource stocks will feel that gravitational pull to move lower. As liquidity shrinks and people get scared, liquidity dries up, right? And especially in a lot of these speculative names. So you could see, even though the prospects are good for the companies, it's the same thing that I just talked about in the gold market, right? There's no liquidity there because no one cares about it. And so if people get scared because the overall market's going down and they have gains, they just start selling to lock those gains in. You could see even though a lot of these companies have great prospects, you could see reduction in prices. Now, once the new liquidity cycle kicks off, they'll be the first ones to recover and overshoot. I think that's really the scenario. That's why I'm still holding cash. It's boring. I hold a lot of cash relative to, haven't really been deploying a lot of new cash into a lot of new names here and there a little bit. But overall, and again, I know it sucks for subscribers because it's like, why am I paying this guy $179 a year to tell me to stay in a money market fund? Well, I mean, because we're waiting for the fat pitch. Okay, when the fat pitch comes across, that's going to 5 or 10 bag. I don't see a lot of 5 and 10 baggers out there. I see that over the horizon, the possibility. That's why I have these watch lists that I put together. But is it time yet? I'm not sure. So boring, yes. Has it been productive for us? Yes. A lot of the things that we got into very early are bearing fruit now. And I will hold through any pullback just because I have such large gains in many of these things. Maybe even add. But remember, when the stock market goes down, all pretty much 95% of the stocks will suffer. So we still haven't made it through a bear market yet. And I think we need to see a pretty significant bear market in the overall stock market to help induce the Fed to kick off the next liquidity cycle. So this is a article. This is something that was going around on Twitter that caused some discussion about whether this is an indication of a shortage or just management by the utility. The article is EDF, which is a French nuclear operator, warns of outages at Cattenom plant to save 6 months of fuel. So French utility EDF warned on Thursday of extra outages at its Cattenom 1 and 2 reactors to save about 6 months worth of fuel before their next scheduled fueling stops in 2025. Quote, as of today, Cattenom one will have to save a quantity of fuel equivalent to 160 days of full load operation, unquote, before its next refueling outage scheduled for 19 April 2025. The fuel saving, quote, will be done through imposed load limitations or outages, EDF said, but did not provide specific dates. So a lot of folks took this as, well, it's showing that there's a shortage of fuel. Well, I mean, I don't really know all the facts here, right? It could be that they just have their fueling outage scheduled here, maybe, and they just screwed up on the outages, or they had better performance, or they kept the reactor running when they usually take a derate. There's a whole bunch of other things that could be, I don't know. I'm not necessarily saying, but it also could be that maybe, I don't know if they extended this outage, if it was scheduled, the refueling outage was scheduled for earlier and the material is taking longer to be manufactured, or if there was a shortage and it screwed up their supply chain. There's a whole bunch of possibilities. So, and one of them could be that they were anticipating certain raw materials to arrive there and they didn't. And so they had to extend the outage timing. The article didn't provide enough information to really say that. But I think we will see that going forward. If you're in a situation where these utilities don't have enough fuel because they didn't, because for the various reasons we've talked about ad nauseum, and they have to start taking derates all over the place, then that would be an indication that that's the situation. But we'll see. And what do I mean by a derate? We'll say the thing's rated to run at 1,000 megawatts an hour or whatever, and you just lower the output. It doesn't consume as much fuel, and then you could extend the runtime. That's what I mean by, because you don't really want to shut the thing down, just go cold iron. You just possibly take a derate down to a certain point. I mean, at some points you can't go below just because it becomes disruptive to everything. But I think that's probably what we'll see as an initial indicator. If there is really, musical chairs situation where people start taking derates to extend the fuel that they already have in their reactor. We shall see. So I talked about, the fact that Chinese are stepping on the accelerator, over $1 trillion in liquidity injections into the economy over the last whatever. Cross-border capital tracks that pretty good. Just wanted to point this out. China iron ore imports, says China collapse, ? Iron ore imports up. This is relative to 22 and 21. I mean, it's kind of fashionable to predict the demise of China. I've said this before, guys like Kyle Bass, that's like for 15 years he's been talking about this. I mean, I don't think anybody really knows what's going on in China. A lot of people having a view on it. I think it's hard to figure out. Do I think that inevitably they're going to have recessions and slower growth? And do they have population issues, demographic issues? Yes, yes, and yes. But in the end, we're all dead too. So I don't know if this crying, I guess if you keep saying the same thing, you'll be right eventually. But if they can continue to do what they've been doing in the past, which is what all governments do, when a downturn, just inject more money. Do they have issues in their property market? Yes. But I don't think us as individual investors or speculators at this level could possibly understand what's really going on there. That's why, even though I'm kind of bullish on emerging markets, I'm kind of shying away from China because I think it's just too hard. It's in the too hard pile. It's too hard to really know. Now, if you wanted to speculate just based on relative valuation and history, then you probably could take a position as a very highly speculative, and just you're hoping for higher prices based on just liquidity, right? But I'm not even prepared to do that. I just put it in the too hard pile. But I do kind of wonder about these folks that terminally, or every year, every month, bashing China. I wonder if it's just a manifestation of just the whole anti-China mindset of the U.S., of the hegemon, and people fall into that thinking. Now, again, they point out the legitimate problems, but is it actionable? That's what you have to ask yourself. Okay, great. If China's going to collapse, when's it going to collapse? Because if they're injecting all this liquidity and the market goes up, then you don't make any money. And the whole point of making these forecasts and doing this analysis is to find opportunities to increase your wealth. And so that's why it has to be actionable, right? And if it's not actionable, yes, it's good to talk about as an intellectual exercise, but what does that really mean? And vis-a-vis making money. So I just wanted to point this out as a kind of a discussion point. This is one, you're seeing shipping increasing in China. I mean, you're seeing indications that the economy is not really as bad as people think. Is it, like I said, is it a manifestation of manipulation by the government? Very possible. Again, it's just probably too hard to really understand. So again, watching ESG crumble before our eyes. This is an article. I think I'll have links to most of these articles in the show notes where I could get links. This is a headline that said electricity prices must rise by 70% to pay for more wind farms. Warning from UK's biggest energy generator comes after latest bidding round received no offers to build new farms. Again, we've talked about this before. High rates just kill these things. This is malinvestment, guys. This is an example of malinvestment. These things, with the subsidies from the government and the incentives from the government, coupled with low rates, low interest rates to finance the debt, coupled with a commodity bull market, which made the input commodities into these things cheaper, was a perfect storm for these things to do well. And now 2 out of those 3 elements of that equation have reversed. We have substantially higher interest rates around the world. And we have, although some of them have weakened recently, we have higher commodity prices, input prices for a lot of the materials that go into these machines. And so this idea that it was just going to be like Moore's law and the prices for power from these machines was just going to get lower and lower over time, I knew that all along that wasn't going to happen. It was a manifestation of a certain set of circumstances that has now reversed. And that's the big problem. So the question will be, I mean, you're even seeing people like Rishi Sunak. He's probably going to get kicked out in the next election in the UK. And you're going to get Keir Starmer, or whatever his name is, from the Labour Party. So will these governments come with even more support? Because that's what these companies are asking for. They're asking for more support. And again, are you really going to go to the population in an election cycle and say, well, we need to raise electricity prices by 70% so we can, pursue this ESG mandates that's going to have some unknown nebulous benefit that you can't quantify? You're going to say this in an election cycle? That's not how politics works, folks. Yes, fanatics will say that, and that's why fanatics don't get elected. So we'll see if it continues. Again, if we go into another cycle of rate cuts down the line, then maybe that relieves the pressure on a lot of these projects. But quite frankly, a lot of these projects simply can't work or will not work with the rates where they are. And I think resource prices are going higher, so that's going to put even more strain. Does that mean none of these things will get built? No, that doesn't mean that. But it means that if you're a marginal player, or if you don't have your act together, you're probably going to, what animals do get taken down in the herd, right? The weak and the sick. And that's, I think, what Siemens Energy is here, because their share price has crashed again. And here's another guy that's in my curation. You should follow. He's big on nuclear. This guy's actually a nuclear engineer, or nuclear scientist. He says in this tweet, Siemens Energy stock is getting crushed today as the company asks the German government for a financial lifeline. Things are turning ugly as higher interest rates raise the cost of new wind turbines, but the ones already built don't work well. Shares down another 39% today. So we talked about back here when the stock crashed back in late June, July, whenever it was, and now we're down another whatever it is, 39%. So this is a company that may not be around long. The good thing is that the overall parent company, Siemens, kind of divested all of this. They saw what was going to happen, I think, and divested all this into this Siemens Energy business. And I think that that was probably a good move, right? Although I think they own quite a bit of it still from the parent company, own a lot of the stock. But regardless, again, you know, that doesn't mean that the whole industry is going to disappear. It just means that the weakest ones in the herd are going to be called out. And again, if we go into a new rate cutting cycle, which I anticipate over the next year, maybe that will be sufficient to again make these projects and some of these companies attractive again. We shall see. Okay, guys, that's it for this week. Appreciate the viewership, and we'll talk to you next week. Thanks.